Recession changes everything, right, Liz? I mean, that's what changes the game in terms of whether stocks are cheap or they need to get cheaper because the economy is going to regress and retract.
Mm-hmm. Well, I think the market right now is trading as if we might be approaching a recession. And there are signals, right? We had a yield curve inversion. We've had one quarter already of a contraction in GDP. I don't think we're going to see a recession this year. So at some point, we'll have to realize that, and the market will recover from it. But I think the recovery here is that maybe just volatility comes down. I don't know that we're going to produce a ton of better returns, especially, which I'm sure Joe will back me up on. You get closer to midterms, you go through the summer, you get closer to midterms in early fall, and there's going to be more chop until we can get past that piece. So I do think that the second half of this year is better than the first, but we can all agree the first was pretty bad. So the second half probably a little bit smoother once we realize inflation may have peaked. We're not going to go into a recession, but we're not going to confirm that stuff until into the third quarter.
That's why isn't it going to be difficult then, Joe, to get any? I mean, I know the prevailing view from folks have been, okay, first half, I'm going to use Tom Lee's word, treacherous. Mm-hmm. Liz kind of painted the same picture. You get through the first half and maybe it's a little more calm in the second half. Mm-hmm. I would almost take the other side because the Fed's going to continue to tighten. They may have to tighten more than we think. Mm-hmm. Even if inflation has peaked, doesn't mean it's going to roll over. You start to get earnings projections coming down. The analysts are too optimistic. They're just delusional, and they haven't gotten the message yet, and they're going to have to take the numbers down.
So, listen, we're trying to give the viewers where they could find opportunities in the market. But without question, I've said this for weeks now on air, this is a process of time. This is not a moment in time. That is not what bottoming ultimately looks like. So to answer or respond to your thought there, Scott, what's the cost of capital going to be? Tell me with finality what the cost of capital is going to be, because that has been the biggest challenge for all these businesses. The cost of capital is no longer free, and I don't know what that cost of capital ultimately is going to be. So that's why last week you saw outflows in crypto. You saw outflows in Apple. You saw outflows in gold. You saw outflows in energy. You saw outflows, the largest you haven't witnessed since April of 2020 in taxable fixed income. The only major asset class where there was inflows last week was treasuries. So I think it goes back to what I said to begin the show, where, yes, you could take ownership of some assets here, but you really have to trade up in quality, because I don't know how much it's going to cost me to fund my operations.
Yeah, I hear you. But, Mike, and last point for you on this, the only reason, well, maybe not the only, but certainly a principal reason why the market stopped going down for a moment and we had a bit of a bounce is because names like Apple and Microsoft stopped going down. And they were where Apple was, had a 130 piece to it, is now back at 146. Why isn't the market able to have any follow through today from what last Thursday and Friday did? Because Apple's doing nothing. It's flat. You can't, to your point, have the mega caps get continually upset for the market to find stability. It just cannot happen.
Well, yes, if you're defining the market as the S&P 500, that's exactly right. And obviously, there's a lot of money in it, and people basically anchor to what it is doing. The equal-weighted S&P has been outperforming the headline by, 3 percentage points pretty much all year. So it's not as, all or nothing as those stocks make it seem. But I agree that if the job is not done in terms of, draining away the valuation excesses and making sure that, in fact, those things are back into line, the Apples and the Microsofts, with what we, have come to expect in terms of valuations under more normal terms, pre-pandemic levels, then yes, that should be at least a net drag on the S&P 500. But I don't think that necessarily tells you if we go to major new lows or, in fact, last week ended up being a decent, pivot to do some buying.
I think real quick, the way to think about the declines and the bounce in the Apple or the Microsoft is understand we're reintroducing buybacks once again. 75% of all buyback authorizations are algorithmic. The other 25% is discretionary. Well, on a day where the market's coming in higher, I don't think companies are going to be aggressively buying back their stock. So Apple, when it's at 138 or 139, sure. That's a point where that discretionary component of the buyback is going to enter the market and add to stability. I think that's the way you have to think about stocks overall. You can't expect that on a consistent basis every day companies are going to be buying back their stock. It's only when markets are down significantly.